Greetings, everyone. Scott Richardson, Dan Brown, Richardson Capital Management, here to present the January 2026 Economic and Investment Update. Hard to believe we already got a month under our belt here in 2026, as it looks like we just turned the page, but time is moving fast. Good news is we had another solid month in the financial markets. The stock market started out the year pretty strong. The U.S. stock market, large cap stocks, up small amount, but small cap stocks kind of, much to our surprise, performed very favorably, as did some of the international markets, developed and emerging markets. So pretty good start on the equity side of the world. And fixed income was relatively flat as interest rates were essentially flat for the month. But big picture, very strong start to the year. And there are a couple different drivers on that. One of them that we want to talk about today is earnings. We've had initial earnings reports come in. They've been very strong. And we got a little bit of update on what's going on the Federal Reserve side of things in terms of interest rates and appointment of a potential new governor. And I'll let Dan do a little talking on that front.
Yeah, so just want to circle back on earnings because we think that will be the main driver of returns for this year for the stock market is just the outlook for corporate earnings. So we've talked about this quite a bit in the past, and again, we think it's important because it should be the main driver of returns as multiples for valuations tend to be sort of high. So as we sit here the end of January, we're about 1/3 of the way through earnings season, and so far the results are very positive. So we see upside surprises both on top line revenue growth and bottom line earnings growth for the most important sectors like technology, which is the largest sector, financials, communication services, all coming in about double digits. So it's very possible we wrap up fourth quarter earnings season with earnings growth about 13%, and that should put the full year 2025 also at double digit earnings growth. And the outlook for 2026 is still very constructive. So we haven't seen any companies really, lower estimates for the full year. Still very encouraging signs. So again, expecting double-digit earnings growth in 2026.
So Dan, if we shift gears and talk a little bit about the Fed, we had a Fed governors meeting this month. The board decided to hold interest rates steady at this meeting, which was the first time in 3 meetings?
Yes.
Prior 3 meetings, they dropped interest rates 25 basis points each meeting. So they put things on hold, which was not a surprise at all to anybody in the marketplace. And quite honestly, I think we probably are under the impression that that's going to stay that way for sure for the next couple of meetings. Current chairman has only a couple more meetings to go, probably going to stay steady state for that period of time. I'll let you talk a little bit more about expectations on the back half, but big picture, the commentary was pretty positive, wouldn't you say? I mean,
Yeah.
Fed Chairman Powell had very positive things to say about the economy. Inflation seems to be slowing. Employment is slowing, but not dramatically. And economic growth is still staying pretty strong. So had pretty positive things to say. So I'd say the takeaway from the meeting was no big surprises and still pretty positive news, would you say?
Yeah. And then we also learned right at month end the appointment or the nomination of a new Fed chair. So Scott, as you mentioned, Fed Chairman Powell's term ends in May. And we've had like 3 finalists that have been in the running that we've heard about and read about. And again, right at month end, President Trump nominated Kevin Warsh to be the next Fed chairman that would be effective in May. So he only needs a simple majority vote by the Senate. So we think that's a fairly low, easy hurdle to clear. And if we look back on Kevin Warsh's tenure, it's pretty impressive. Especially since he actually has been a Fed governor from 2006 through 2011. And if we think about that time period, that was during the great financial crisis of 2008, 2009. The Fed had to be very reactive with a number of new emergency policies, to provide liquidity to the market. They did some bond buying, some quantitative easing, which was a new term that we all learned about, and came up with programs to give capital, injecting capital into banks. So we think it's a pretty solid pick, and we'll pay attention to the nomination. But again, we would expect that to clear. And the market seemed fine with that pick. Again, his name has been out there for a while, and investors seem fine with that.
So shifting gears, we wanted to provide a quick update on what's going on, what we're seeing in the real estate sector. As many of you probably know, the real estate sector has been under a little bit of stress the last 18 to 24 months. Primarily, it started in 2022 when interest rates increased dramatically to fight off the inflation that was going on in the economy. And since that point, the real estate, whether it's been multifamily, office, industrial, really didn't matter. All have been under a fair amount of stress. And we're starting to see some signs that that's kind of shifting. Last year, we had a kind of the first year where real estate's kind of started to kind of reassert itself again. And there's a couple, two or three things going on there. But Dan, just give us kind of a feel on kind of some of the outlook and trends that we're seeing that are driving that.
Yeah, so the reason we're somewhat optimistic with the outlook is what you mentioned that we think real estate values have turned the corner last year in 2025. So we've now seen 5 consecutive quarters of positive increases for real estate values. Granted, it's very small, but nonetheless, it's positive. So that's 5 consecutive quarters of increases through the third quarter of 2025. And then the outlook is even a little bit more constructive for 2026, mainly because real estate is a very supply demand driven market.
Mhm.
And as we look out at supply, there's going to be a lack of supply that's going to continue for a while. So the graph that we're showing here is looking at real estate deliveries. So the blue bars are historical deliveries starting in 2017 through 2025. And then the beige bars is the outlook or forecast for 2026. And you can see for the 5 different property sectors that we have here, the outlook for new supply coming on the market in 2026 is pretty muted. And again, a lot of that is related to that higher interest rate environment from, say, 2022 through mid 2024 when the Fed was aggressively raising interest rates to fight inflation. So that sort of is having a hangover effect still today because a lot of projects just didn't start in 2024 and 2025. And a lot of these projects take a couple years to complete. So think of 2026. So again, we think that supply is going to be down this year. Again, and that should serve as a natural boost to real estate values. And as it pertains to like home values, it's probably good news if you're looking to sell your house because we think the real estate values for single family homes will continue to either plateau or go up a little bit.
Mhm.
And as far as an outlook on interest rates, we think that'll also serve as a minor tailwind because we expect a couple more interest rate cuts out of the Federal Reserve this year in 2026.
All right, Dan. So to put a wrap on things for the month, started out the month with nice, strong returns in the equity markets, relatively flat in the fixed income markets, and the initial indications on earnings, corporate earnings, pretty darn strong, which hopefully will continue throughout the year. That said, can you kind of give us 30 seconds on kind of what the outlook from our perspective is for the year going forward?
The outlook is still constructive. So the 3 big pillars that we're kind of paying attention to are, monetary policy. So what's the Fed doing? We think the Fed will continue to cut rates, not as much as last year, but 2 to 3 quarter point cuts this year. And that's not just a U.S. phenomenon; that's a global phenomenon. And then fiscal policy, we would expect that to be additive this year in 2026, courtesy of the budget bill that was passed back in July. A lot of those effects will kick in right away, in 2026 in January, both on the corporate side and the personal side. And then lastly, probably the most important building block that you mentioned is corporate earnings.
Mhm.
So we would expect another year of double-digit earnings growth for 2026. So that is our economic and investment update. Thank you for your trust and support, and feel free to reach out to us if you have any questions or concerns. Thank you.